We found a wealthy investor trading Cisco Systems, ticker symbol CSCO, today, March 7th. And so in this video, we will analyze this unusual trade to find out if this investor thinks the stock will go up or down, so that we can also trade alongside this wealthy investor. Because as we all know, the rich are getting richer on Wall Street because they have access to information where they are able to find out whether stocks will end up higher or lower in the future. So without further ado, let's get to the data analysis as usual. As you can see here, today at 1:53:26 second mark, 9,174 contracts for the May 17 options, 52.5 strike calls. This investor was paying $75 for each of these call options. So a quick calculation of the total trade cost, 75 times 9,174 is $688,000. So why are they trading this much money on Cisco? Let's take a deeper look at the option chain to find out. So here for the May 17th, we can see here the 52.5 strike calls. Total volume of 11,532, which is much greater than the open interest, so we know that these are opening trades. We believe they are buying these call options to open, and that is why we are also in the same position as well. But we are positioning size much less than our higher probability of profit trades, because this trade does not meet our threshold for a high chance of profit. If you are interested in the higher probability of profit trades, make sure to go to our website at the top here, where you can learn how to gain access to the trades of wealthy investors that have higher probability of profit, where it exceeds certain criteria, such as being over $1 million in trade value. Okay, so as we explained, they were buying these call options for $75 each. And when you analyze this trade, you can see that this is clearly a bullish long trade with a delta of 25 positive. If it was a bearish short trade, it would have been a negative delta. Okay, and from this graph, we can see this is bullish because on the x-axis, this is the share price of Cisco, currently trading at $48.90. And so as we move the mouse forward along this x-axis, where the share price increases, you can see the profits increase. And if it goes down, it is a loss. So this is a bullish long trade. When the lines are above the zero, it is profit. If it's below, it is a loss. And the blue line represents the expiration, May 17, and the purple line is the current date, March 7th. And so this option, if it starts to increase, share price increase quick enough, the options will be able to become profitable immediately. If it does not, it will decay in value. So that is the risk with trading options. There is a theta decay, time decay here, -1. Okay, and that is why at expiration, once we're at May 17, you can see the break even here, where this meets the 0 line here. Break even is about $53.24. Okay, so it has to be above $53.24 by May 17 for these options to be profitable. Or it could go up much quicker and it could be immediately profitable. You can see the strike price of 52.5 is right here. So it has to break that at expiration. And 52.5 is a resistance level. Notice that here early on this year in January 26th, the end of the month in January, this is when this resistance was met and it started to trade down lower. So this investor, for whatever reason, believes that Cisco will break that resistance in the near future. Okay? So if you want to learn more about our work and gain more access to more of these trades, but with a higher probability of profit, so you can diversify your portfolio, go to our website. We'll put a link up here. Because the trades of wealthy investors are not always right. And that's why we have to diversify our portfolio to increase our profits while reducing our risk. Please smash the like button, subscribe if you haven't, and have a wonderful